After studying this module, you shall be able to understand the meaning of CVP, the concept of break-even analysis, the methods of break-even analysis, the concept of margin of safety, the concept of PV ratio, the concept of cost indifference point, the concept of limiting factor. Every organization needs to earn profits to stay in business. Cost volume profit, that is CVP analysis, helps the management of an organization in planning profits. Management of an organization makes various plans to increase its profitability. The CVP analysis helps management in providing answers to the questions like what will be the effect on profit if an additional sales expenditure of rupees say 2,50,000 increases the sales by 50,000 units. How many units of a particular product need to be sold for earning a profit of rupees 3 lakh? What will be the profit earned by an organization if it sells 2 lakh units? The CVP analysis studies the relationship among three factors of business operations, namely the cost of production, the volume of production or sales, and the amount of profit. The aforementioned factors have a cause and effect relationship among them. For example, cost of a product determines its selling price, which in turn determines the level of profit. The selling price of a product determines the volume of sales of that product, which affects the volume of production of that product, and this in turn affects the cost of the product. CIMA London defines CVP analysis as the study of the effects on future profits of changes in fixed cost, variable cost, sales price, quantity and mix. The study of CVP analysis is important for the management as it helps in understanding the impact of changes in selling prices, changes in volume of sales, changes in variable cost and changes in fixed cost on the net profit of an organization. Break-even analysis. Interpreted in both narrow and broad sense, break-even analysis is a technique used to study CVP relationship. In the narrow sense, it is concerned with determination of break-even point, that is the level of production and sales where there is no gain and no loss and total cost is just equal to total sales revenue. In the broad sense, it is concerned with the determination of probable profit or loss at a particular level of production or sales and the amount of sales to earn a particular amount of profit. Now we can discuss about a few assumptions in the break-even analysis. The break-even analysis is based upon certain assumptions. These are: all the costs can be segregated into their fixed cost and variable cost component. The variable cost per unit of product remains unchanged while the total variable cost changes directly in proportion to the volume of production. The total fixed cost remains constant at all levels of production. Changes in the volume doesn't affect the selling price per unit. Generally, there is only one product. In case there are multiple products, the sales mix will remain unchanged. The volume of production is always equal to the volume of sales. The productivity of each worker remains unchanged and the general price level remains unchanged. Now let us discuss about a few methods of break-even analysis. The break-even analysis can either be performed by using the algebraic calculations or by using the graphic presentation. The algebraic method. In the algebraic method of break-even analysis, break-even point is calculated, that is the volume of output or sales at which total cost is equal to total sales. Therefore, a break-even point is the point of no gain and no loss. It indicates the minimum point of production at which the total cost is recovered. An organization begins to earn profits after it moves forward from the break-even point. Break-even point in units is equal to total fixed cost divided by contribution per unit. Break-even point in rupees is equal to total fixed cost divided by contribution multiplied by sales, or this is equal to total fixed cost divided by PV ratio. Now we can look at one example. Calculate the break-even point in both units and rupees from this given information. Total fixed cost is equal to rupees 15,000, selling price is equal to rupees 15 per unit, variable cost is equal to rupees 10 per unit, and the solution to this problem is contribution is equal to S minus V, that is equal to rupees 15 minus 10 is equal to rupees 5 per unit. The PV ratio is equal to C upon S multiplied by 100, that is 5 upon 15 multiplied by 100, which is equal to 33.33%. So break-even point in units, which is equal to total fixed cost divided by contribution per unit, will be equal to 15,000 divided by 5 is equal to 3,000 units. Break-even point in rupees is equal to total fixed cost per contribution multiplied by sales, which will be equal to 15,000 divided by 5 multiplied by 15, and it will be equal to rupees 45,000, or break-even point in rupees is equal to total fixed cost divided by PV ratio, which will be equal to 15,000 divided by 33.33%, and it will again be equal to rupees 45,000. Now there is graphic presentation method. In the graphic method of break-even analysis, break-even chart is prepared. The chart indicates graphically the profit and losses at different levels of sale volume. The break-even point in the chart is the point at which the total cost intersects with the sales revenue line. The break-even chart provides this information. Profits are generated where sales revenue is greater than the total cost. Losses are incurred where sales revenue is less than the total cost. Break-even point is the point where sales revenue is equal to total cost, that is the intersection point of sales revenue line and the total cost line, indicating a point of no gain and no loss. More the output, more is the variable cost incurred, suggesting that variable cost vary directly with the output. Fixed costs are constant for a range of output produced and do not vary with the output. They are incurred when there is no output in the beginning of the production cycle. Total cost line represents the combination of fixed cost and variable cost. Because of this, there is cost even when output is nil, representing the fixed cost. As the output increases, the total cost line varies with it. Margin of safety is the extra amount of sales which is expected to be generated when the budgeted or the actual sales is compared to the break-even level of sales. Margin of safety. The margin of safety measures the sensitivity of the budgeted sales volume compared with the break-even sales volume. It is the difference between level of sales achieved and the level of sales required to break even in the absolute or percentage terms. Margin of safety in units is equal to budgeted or actual sales volume minus break even sales volume. Margin of safety in percentage is equal to budgeted sales volume minus break even sales volume divided by budgeted sales volume, and this is to be multiplied by 100. Also, margin of safety in units is equal to profit divided by contribution per unit. Margin of safety is also directly related to profit. Hence, profit is equal to margin of safety multiplied by PV ratio. So, margin of safety is equal to profit divided by PV ratio. Now, we can discuss an example. Calculate the margin of safety in this situation. Break-even point is 30%, actual sales rupees 30,000, actual sales 50,000 units, break-even point 35,000 units, then break-even point is 60%, PV ratio 35% and profit rupees 45,000. The solution to first type of problem is margin of safety is equal to actual sales minus break-even point, which will be equal to rupees 30,000 minus 30% of rupees 30,000, which will be equal to rupees 30,000 minus 9,000 and this will be equal to rupees 21,000. In second case, margin of safety is equal to actual sales minus break-even sales, which is equal to 50,000 minus 35,000 units, which is equal to 15,000 units. In third case, margin of safety is equal to 100 minus break-even point, which is equal to 100 minus 60%, which is equal to 40%. In the fourth case, margin of safety is equal to profit divided by PV ratio, which is equal to 45,000 divided by 35% and it will be equal to 1,28,571. The larger is the size of margin of safety, the more are the chances of a business to make profits even after a fall in the amount of sales and stands a better chance of survival. When the margin of safety is not satisfactory, various steps could be taken to improve it. Some of them are increasing the volume of sales, increasing the selling price, reducing the fixed cost, reducing the variable cost, and improving the mix by increasing the sales of products having larger PV ratio. Now we can discuss about contribution and marginal cost equation. The concept of contribution is vital for studying break-even analysis and taking managerial decisions. Contribution, that is C, is calculated in this manner. Contribution is equal to sales minus variable cost or C is equal to S minus V, where C is contribution, S sales and V is variable cost. Also, contribution C is equal to fixed cost or F plus profit or P, or contribution C is equal to fixed cost or F minus loss or L. Therefore, using these equations, S minus V is equal to F plus P. Hence, if any three of S, V, F and P are known, the fourth one can be calculated using either or a combination of these equations. These are P is equal to S minus V minus F, P is equal to C minus F is equal to C minus P, V is equal to S minus F minus P. Now look at this example. Calculate the amount of contribution in each of the cases. Case 1, fixed cost is equal to rupees 10,000 and profit is equal to rupees 6,000. Case 2, variable cost is equal to rupees 8,000 and sales is equal to rupees 12,000. In case A, contribution is equal to fixed cost plus profit, which is equal to rupees 10,000 plus 6,000, that is rupees 16,000. Contribution in case B is equal to sales minus variable cost, which is equal to rupees 12,000 minus 8,000, which is equal to rupees 4,000. Now let us discuss about PV ratio. The PV ratio gives the relation of contribution to sales and hence is also known as contribution sales ratio. It indicates the rate at which profit is being earned by an organization. The higher the PV ratio, higher is the profitability of an organization and vice versa. The PV ratio is generally used for calculating the break-even point, the amount of profit at a particular level of sales, the volume of sales required to earn a particular level of profit, the amount of profit when the margin of safety is given, and the volume of sales required to maintain a level of profit if there is a reduction in the selling price. PV ratio is equal to contribution over sales, that is C upon S. This can also be written as S minus V upon S. Here C is contribution, S sales, V is variable cost. Now the PV ratio, which is equal to C upon S, C can be written as equal to S multiplied by PV ratio, and S is equal to C divided by PV ratio. The amount of contribution can be easily calculated from a given amount of sales when the PV ratio is given. The PV ratio can also be computed by using the change in contribution to change in sales, or by using the change in profit and the change in sales. Therefore, PV ratio is equal to change in contribution divided by change in sales, and PV ratio is equal to change in profit divided by change in sales. Now we can discuss another example. Calculate the PV ratio in these situations. Case 1, variable cost is equal to rupees 50 and contribution is equal to rupees 50. Case 2, year 1 sales is equal to rupees 40,000 and total cost is equal to rupees 30,000. Year 2 sales is equal to rupees 50,000 and total cost is equal to rupees 35,000. The solution is, in case A, PV ratio is equal to contribution divided by sales, which will be equal to contribution divided by variable cost plus contribution, that is, it will be equal to 50 divided by 50 plus 50, which is equal to 50 divided by 100, that is 50%. In case B, profits are equal to sales minus total cost. Therefore, for year 1, profits are equal to rupees 40,000 minus 30,000, that is rupees 10,000. For year 2, profits are equal to rupees 50,000 minus 35,000, that is rupees 15,000. The PV ratio, which will be equal to change in profit divided by change in sales, this will be equal to 15,000 minus 10,000 divided by 50,000 minus 40,000, that is 5,000 divided by 10,000. So the PV ratio will be equal to 50%. Now let us discuss about profit volume chart. A profit volume chart is a variation of break-even chart depicting graphically the relationship between the profit earned and losses incurred at different levels of sales volume. It is a summarization of the break-even chart, where the line represents the total profit, that is sales minus cost. When the rise is above the horizontal axis, it means that production is yielding a profit. Before this point, it means that production yields loss. The break-even point is the point where the profit line intersects the horizontal axis. Now, a few assumptions are considered while preparing the profit volume chart. Number 1, there exists a single product or a single mix of products. Number 2, the fixed cost, the variable cost and the selling price are constant. Number 3, the level of production will be equal to the level of sales. Limiting factor. The primary objective of every business is to earn more and more profit, but it is not easy to achieve this objective as there are various factors involved. To illustrate, a business might not be able to sell all its products. In this case, sales become the limiting factor for that business. Therefore, a limiting factor or a key factor is that factor which at a particular time period affects the volume of output. Some of the limiting factors could be sales volume, materials, labor, production capacity, financial resources. The limiting factor technique helps in indicating the best course of action in the situations where alternatives are available. The best situation is reached when the contribution per unit of the limiting factor is maximum. For example, choice has to be made in producing two products A and B. The product A yields contribution of rupees 20, while the product B yields contribution of rupees 24. Then in this case, producing product B is more profitable. But if material is a limiting factor and the product A consumes 4 kilograms of material while product B consumes 6 kilogram of material, the contribution in case of both the products will be product A is equal to rupees 20 upon 4. This will be equal to rupees 6 product B, which is equal to 24 upon 6, which will be equal to rupees 4. So in this scenario, producing product A will be more profitable as it gives greater contribution per unit of limiting factor. The cost indifference point. It is that level of output at which the total cost or the profit of the two alternatives are equal. This helps in cost minimization by identifying the alternative which yields more profit at a given level of output or sales. A machine having a lower fixed cost and a higher variable cost per unit is more profitable when the actual sales are lower than the cost of indifference point and vice versa. The formulas for calculating cost indifference points are cost indifference point in units is equal to difference in fixed cost divided by difference in contribution per unit. Cost indifference point in rupees is equal to difference in fixed cost divided by difference in PV ratio. Now look at this example. A company has to choose between two machines, that is machine 1 and machine 2. Find out the level of output where the two machines are equally profitable given this information. The solution to this problem is the contribution, which is equal to fixed cost plus profit. So the contribution for machine 1 is equal to rupees 40,000 plus 40,000 is equal to rupees 80,000. Contribution for machine 2 is equal to rupees 26,000 plus 34,000, which is equal to rupees 60,000. Contribution per unit of machine 1 is equal to rupees 80,000 divided by 20,000, which is equal to rupees 4. Contribution per unit of machine 2 is equal to rupees 60,000 divided by 20,000, which will be equal to rupees 3. Break even point, which is equal to fixed cost divided by contribution. So break even point for machine 1 is equal to 40,000 divided by 4 is equal to 10,000 units. Break even point for machine 2 is equal to 26,000 divided by 3, which will be equal to 8,667 units. Cost indifference point is equal to difference in fixed cost divided by difference in contribution. That is, this will be equal to 40,000 minus 26,000 divided by 4 minus 3, that is 14,000 units. Therefore, at 14,000 units, both the machines will give the same amount of profit. Uses of break-even analysis. The break-even analysis has various uses. On the basis of this discussion and several studies, some of its important uses can be summarized in this way. It helps in determining the break-even point, that is the point of no loss and no gain. It helps in arriving at the selling price and the sales volume, which will help a business earn the desired profit. It helps in determining the cost and the revenue at different levels of output. It helps in arriving at most profitable sales mix. It helps in ascertaining the comparative profitability of each product line. It helps in comparing the profitability of different business houses. It helps in management in the decision making process. There are certain limitations of break-even analysis. Break-even analysis is an important tool of management and control. Still, it suffers from various limitations because of some of its assumptions. The non-viable nature of the assumptions of the break-even analysis can be explained in this way. Some of the cost and their components can't be compartmentalized in variable or fixed cost categories. Many of the variable costs may not necessarily move in direct proportion to the volume of production. Fixed costs don't always remain the same, they remain constant only within a limited range of output, and they tend to increase beyond that range. Selling price doesn't remain unchanged as the volume of output changes. In practice, an increase in output can be sold only after reducing the selling price and in turn affecting the sales line. The cost of securing funds to expand is disregarded in break-even analysis. If a business sells several products, it becomes difficult to prepare and evaluate a number of profit graphs covering integrated segments of independent activities. Now we can summarize this module. The break-even analysis is used to study CVP relationship. The PV ratios give relation of contribution to sales. Cost indifference point is the output at which total cost or profit of two alternatives are equal. Break-even analysis assumptions suffer from certain limitations.